So let's start the first simple thing, the trading strategy. Maybe I have first to define the topic trading. When I say we are doing trading systems or trading strategies, I'm talking about technical trading. I'm talking about trading with indicators. I'm not talking about investments. I'm not talking about buy and hold. So everything you will hear today is about active trading systems. And I think it's a difference. Sometimes people use the word trading, but in fact, they are talking about investments. So I talk about trading, and I'm doing trading in a short time view. So let's start. A trading strategy, each trading strategy, and in fact, also each investment strategy contains the following puzzle pieces. The first is what to buy, which instrument, or in portfolio trading, which portfolio we would like to trade. The second thing is about timing, when to buy. It's the entry. The third is how much to buy, because I think you won't want to buy only one share of Apple or something, of Tesla. So you have to do a good position sizing. That's point or puzzle piece number 3. And the fourth, puzzle piece is the exit. When to take profit, when to sell. And all these 4 pieces, they are important for every stock market trading system, but also if you're doing investments. You can see here a 5th spot, and that's the so-called position priority, the transaction weight. What's about this transaction weight, position priority, I will show you later. And of course, the puzzle pieces, they have, also each puzzle piece have to work for themselves, but they also have to work together. And if you find good rules, good solutions for all these points, you have a good trading strategy. And this is very important to understand, that every piece has to fit to the other. And there is no best exit for all entry solutions. And there is no portfolio for all entries. All the pieces have to fit together. Okay, so target market analysis, how to start trading. What we are doing here is trading stocks, trading US blue chips. When I say blue chips, I mean S&P 500 universe. That are blue chips. And if you're doing stock trading, you also will find out that going long is in common the best solution. Short selling, sometimes it might work, but in general, you should trade stocks. And I have to say stocks when you are doing trading end of day based, not intraday trading. We are talking about end of day trading. Then it's the best solution to do long only trading. So US blue chips, long only trading. And in this universe, we are talking now about target market analysis to bring some structure in your trading. About the question, how should you trade? You can divide trading systems in pro-cyclical and anti-cyclical systems. I will show you what I mean with this. Pro means you are trading in the direction of the prevailing trend. And no surprise, anti-cyclical means you are trading against the trend. And if you're looking at trading systems from this point of view, you have a little structure. You can say, what should I do, pro or anti-cyclical? And this question is no question about what you like or what you think that it's better. It's a question of facts. It's a question of what works better and how to find this out, what works better. Let's see here two examples. You can see here two charts. On the left-hand side, you have a daily chart and the price is going down. And on the right-hand side, you have a chart and the price of the stock is going up. And when I say up and down, I don't mean the whole chart. What I mean is just the movement of the last couple of days. Let's say the last 3 to 5 trading days. And you can see on the left side, we have some red candles. We have also a small green one, but it's still a down day. And on the right side, we have green candles. The last 3 days are up days. And that's the moves that we are looking for. Is the stock going down and you make a long entry, then you are trading reversal systems, swing trading, mean reversal, contrarian trading, whatever. There are many different names for the same kind of trading system type. So going long, if the price goes down, is you make an anti-cyclical entry. Going long, when the price goes up, then you're doing trend following or breakout trading. And here is the separation of the two kind of trading approaches: pro-cyclical or anti-cyclical. And now, as I said before, it's not the question what you like, it's the question what works better. And our goal now is to find out with some simple basic backtestings what is the solution that works better, and that we are going to do now. And let me switch to my backtesting software. And now you should see the backtesting software. It's called Wealth Lab. Maybe you know it. And with this software, you can do portfolio backtesting. That's what we want to do right now. And this software is also for non-programmers. So you don't have to do any coding to develop very, very good trading strategies. You have here so-called building blocks and a building block solution here. And on the left-hand side, you see all the building blocks you have. And what you have to do is only drag and drop some conditions or some entry or exit rules to this builder here. And so you can build up some trading strategies without coding, because lots of my clients, they would like to trade, they would like to develop trading systems, but they are no programmer, and so you don't have to code a single line with this building blocks here. So let's move on. What we are going to do now, as I said before, is we would like to find out what works better: going long when the market goes up or going long when the market goes down. And if you have find out this, you can build on this, because first you have to know how to design your strategy. Would you like to do trend following or would you like to do contra trend trading? And then you can move on. But first, that's, I think, the first step. How does my target market work? And that's the reason why I call this step target market analysis. And to do this, I have here prepared a first simple trading strategy. I will explain you everything. Remember the puzzle pieces, the slide with the puzzle pieces. We have here our entry logic. Buy at market when, let's open this, when the close makes a 10 bar high. You can see here the indicator is the close at new high. Here high or low, we choose high, bar range 10. The close makes a new 10 bar range. That's our entry. So this, next one, next block, different color, sell, this is our exit block, our exit puzzle piece. Sell after 5 bars, very simple, only time exit, nothing else. So this is our entry, check, this is our exit, check. So we have some more settings to do. There are a lot of settings, but I will only explain the important one. This is important. It's our underlying, it's our portfolio. Of course, you also can trade one single stock symbol. Can put it in here. But what we would like to do is portfolio trading. So we are trading. You have here many different portfolios. I'm choosing S&P 100 for this sample here. So that means we are trading not the index, we are not the future, we are trading all stocks in this S&P 100. You have here daily scale, end of day based trading, no intraday trading. And this is our data range, our observation period, 20 years. Let's say 20 years, okay? What we have, so this is puzzle piece number 3, the portfolio, the underlying. And here comes piece number 4, the position sizing. Let's do here simple position sizing, starting capital 100,000 and percent of equity 10. 10 means you can do up to 10 trades at the same time. 10 trades with this rules. So that's all we need for our first backtest, and we are starting it, run backtest. And here are our first results. Of course, you have a lot of key figures here, but let's focus for this test here only to the first line, analyzed percentage return. What we have here is 4.17%. Let's notice this. And that's the first simple pro-cyclical approach to our stock market trading, because we are buying if the price makes a new 10-day high. It's a first try, very simple. Okay, so let's do now the opposite. Close makes a new low. Everything else stays the same. And now we have to look if we're doing better or worse here. Let's do the backtest. Okay, so we're doing much better. We had before 4.17%, and now we have more than 12%. So that might be a first hint that it's better to buy the losers of the last day. But of course, we have too less information to determine this. We have to do more research. Let's try a similar approach, but a little bit different. What we are doing now is we remove this block. We pick another one, indicator compared to a value. We grab this block and put it on here. And what we are doing now is, let's still remember the slide with the two charts. Price goes down, price goes up in the last couple of days, and we try to simulate this. What we need here is an indicator called, I think there are many indicators that, but you can use this one. It's called consecutive up. Consecutive up indicator means the price is going down for, let's say, at least 3 days. Consecutive up indicator is greater than or equal to 3. That means the price is going down for 3 consecutive days, and at market open on day 4, you make the long trade. You're going long. Consecutive up, greater than or equal to 3. And that's a different way for an pro-cyclical approach. Let's do the backtest once again. Okay, performance is not really good, but it's at least positive. Plus 0.05 APR, annualized percentage return. And again, we are doing now the opposite. Consecutive up means 3 days up. Consecutive down means 3 days down. Let's do the backtest. Okay, a very good performance. And once again, you can see that the anti-cyclical approach works better. So my experience is, if you are going to trade US blue chips on end of day basis, long only, then it's more easy to develop trading strategies that are buying the losers of the last couple of days. I don't say that trend following or breakout strategies don't work. They will work, but it's easier to start with backtesting with simple contrarian approaches. Because as you can see here, what we have done is our entry and exit logic, our rules, they are so simple. Maybe they are too simple. However, but you can see some hedge funds would be happy to have this. So, of course, that's not a system I would like to trade, but it's the first step how you should do your trading. And you can try this pro versus anti-cyclical entry with different indicators, with different settings. It will always be nearly like this, what you have seen now. So it should always be that the anti-cyclical approach is better in case of performance. Yeah, of course you have to look at so many other key figures here, but if you are looking just at the analyzed percentage return, you get better numbers with this. Okay, so that's the first attempt to create a trading strategy. So we will focus for this webinar now on this anti-cyclical approach.